Hi everyone. In this quick demonstration we're going to explore different inventory methods. We'll specifically look at Fifo, Lifo, and average cost. And we're going to base it on the transactions you see on the screen. So we're looking at transactions for the month of June 2014. And we're going to assume we started off with 120 units at a cost of $5. So that's $600 of inventory cost in beginning inventory. Then on June 20th we had a purchase. On June 20th we also had a sale. On June 23rd we had a purchase. On June 29th we have a sale. And at June 30th we have ending inventory of 240 units. Okay, let's look at FIFO first. Now FIFO stands for first in, first out. And what that means is we use the assumption that the earliest items are the first ones sold. So the first ones purchased or the first ones on hand are the first ones sold. Okay, well let's figure out how many units we sold. And let's use this little formula. Take the beginning, then we're going to add what we purchased, and that will give us goods available, or simply available, less ending inventory would give us goods sold. Alright, so we know in beginning inventory we had 120 units, and we had purchases of 370, and then 500. That's it, just those two purchases. So that comes to 870. So goods available, if I just create a quick summation there, is 990. And they told us that we had 240 units in ending inventory. So if we subtract 240, in fact, let's show that as a negative number. I'll make it minus 240, and then that way I can just use the summation again. And we come up with goods sold were 750. Now sometimes you may want to actually change this formula and work it backwards, where you come up with goods available and say less what was sold equals ending inventory. And you could approach it this way too. Okay, so if we want to work it that way, we'd say the goods sold would be equal to the 100 units plus the 650 units. And of course we're going to make that negative. So I'll just put a negative in front of the formula, minus the sum of those two, if you will, and we come up with the 240 in ending balance. And that's the typical way I've seen this formula used, but either way would work fine. Okay, so now we have the quantity of goods sold. We know what that is, 750, and we know ending inventory. And what we need to calculate, whether we're using FIFO, Lifo, or average cost, is two things. We need to know the value of ending inventory, and we need to know the value of cost of goods sold. Now if you think about it, it really is an allocation of the goods available, right? We had 990 units. We have to come up with the value of that, and then we're going to allocate a portion of that to the goods that were sold, and that allocation would appear in the financial statements as cost of goods sold. And the other allocation of that winds up as the value of ending inventory. So with first in, first out, we assume the first one in is the first one out. So if we want to value the ending inventory, we know that the last items purchased are still on hand. So let's work out the ending inventory first. Okay, so let's say we're going to calculate the ending inventory using Lifo. Well, I know I've got 240 units. I mean, I'm going to use the same columns that we see above. So how do we come up with that value? Well, the last purchase we had was at 500 units. If all I have left is 240, then I know the entire layer of the ending inventory of those 240 units came from that last purchase. Oh, and by the way, I do mean FIFO. First in, first out. The first one in is the first one out, so the last one we purchased is still on hand. Our purchase was 500 units, right? It's $7, so we know the 240 units of those 500 are still on hand. So now I know that my ending inventory is 240 times $7. My total cost or value of the ending inventory is $16.80. Okay? Alright, now if we wanted to know what's the value of the goods available, well, it's the sum of the beginning inventory and the purchases. And really all we need to do is put a total here. Here I'll just put the word total. And I'm going to insert a line so we recognize we've got a couple different schedules going on here. And we could just sum the total cost and the total purchases, which will be the beginning dollar through that purchase, right? So let me hit yes. The sum of my cost and my two purchases was equal to $6,320. Okay, so back to using this analysis here. If the total cost of the goods available considers the beginning and the ending, then we could put $6,320 to represent the goods available. If we know the ending inventory is valued at $16.80, then we know the difference had to have been the cost of goods sold, right? So we just subtract the $16.80 from the 6,320. The goods available less the ending inventory tells us that cost of goods, the value of the cost of goods sold using FIFO was $4,640. Now you could also calculate that correctly. If you wanted to calculate cost of goods sold directly, if you will, from the schedule, we could do it this way. Our first sale was 100 units, right? So what was the cost of the 100 units? Well, the cost would have been from what we had on hand. We had 120 at $5, so $5 of those units, the sales cost would have flowed out with that sale. Now, we still have 20 left at that unit, so on the next sale, we've got a sale of 650 units, right? So the number of units that were sold at one layer would have been 20. By the way, I'm going to, at this point, put the units in parentheses because I'm going to show the costs for each unit separately. So the second sale we had was for 650 units. Well, we had 20 left from beginning inventory, right? We had 120 to start with. 100 was sold, so we had 20 left. So I got 20 at $5. That's coming from the $5 right there. And I still have 630 more units to go. So on that same sale of 650 units, I now am going to take care of that entire $370 of units purchased. Excuse me, 370 units. And those cost us $6 each. Alright, well, I still have to get to 650 units. The sum of those is 390. So I know I've got 650 minus the 20 plus the 370 left to account for. and that's 260 units. And those 260 units come from that second purchase, because we've already assumed that the 100 units were sold as part of the first sale, and then the 20 left and the 370 have already gone out the door. So now I have 260 left that came from the last layer that we purchased. And I say layers because that 20 represents the first layer. The 370 came from that purchase, the layer that we acquired on June 20th. And then 260, the units left. And the reason I came up with 260, remember, if I sum all three of those, that equals 650, the units there. Okay, now I just extend those across. Now this is sort of a long way to do it, which is why I like to just do ending inventory directly and force the difference to cost of goods sold. But if you wanted to do it directly, you could. Okay, and at this point I'd be able to calculate the total cost of goods sold directly. Okay, so now you can see I'm going to enter this equal sum E22 to E25, and what do I get? I get 4640. That's my total cost of goods sold. Now I know that's right because we also forced it here above, right? So because that number equals that number, we've now seen two methods to come up with that number. And again, I think the easiest way is compute the ending inventory and the goods available and just force the difference. But you can just get it directly if you needed to. Okay, so that's an example of how we would come up with ending inventory under FIFO, as well as calculating cost of goods sold under FIFO. Now you may ask, well, why do we need this? Because we're going to make these kinds of entries. Let me just put a debit and a credit here. Right? Well, what's going to happen is we're going to record sales for the month, and let's assume we just do it in one lump amount. So, and let's assume it's on open account. So we're going to debit accounts receivable, right, for the full amount of sales for the month, and we're going to credit sales. And we don't know what the dollar sales are, so I'll just use X's. And if you want, you can also assume, well, we make this every time we had a sale. We make this entry on the 20th, and then we make it on the 29th. And then each time you've got to calculate cost of goods sold. But we're going to assume we're only doing this once a month, so we're going to calculate cost of goods sold at the end of the month. So now I've got to record a debit to cost of goods sold and a credit to inventory. Okay? Well, in our example, the debit to cost of goods sold would come from that calculation we came up with, and the credit would reduce inventory by 4,640. Okay, so that's the entry we're trying to make. That's why we're doing this. Let me underline this and maybe center this. This would say account up here, just to, you know, make that look a little bit more like what a journal entry would look like. We could actually even make it more so. Alright, so that's our example of first in, first out. Now, let's go through the same example using Lifo. I think what I'm going to do is copy this down here. Actually, no, what I'm going to do instead, do this in Excel. I'll create a number of new rows. And we'll work it again. Okay, so now the FIFO's off the screen. Now we're going to do the same thing with Lifo. So this time we're going to calculate ending inventory with Lifo. Again, we know the units are 240, But with Lifo, we assume the last one in is the first one out, which means what's in inventory is what you started with, because you can think of Lifo as, all right, we've got a barrel of, I don't know, monkeys, a barrel of nuts, of widgets, and we throw them into the bucket, and then every time we sell one, we pull it from the top. So the ones that we started with are at the bottom; they never get used. That's the way you can think about it. So the last one in is the first one out. That means the ending inventory started from the beginning amount. So my ending inventory consisted of two layers. I had 240 units. I only had 120 from beginning inventory. So I've got 120 at $5, right? I got to copy that over. Okay, so by the way, that should be a formula. Let me do it this way. Equals 120 times $5. Okay? But I had 240 left. So the next oldest purchase was 370, and I know I only need 240 more, right? Because I had 240 less the 120 we've already counted as ending inventory. I had another 120 from the June 20th, 2014 layer. That was the purchase we occurred there. That time we acquired it at $6. So if I copy this over, I can then come up with my ending inventory. Now I need an extra row here because I need to put a total here. So we'll sum that. So now I know that ending inventory is 1320. Well, if I know that ending inventory is 1320, I can then slide up and say ending inventory here is 1320, or excuse me, ending inventory is 1680. Wait a second, I entered that incorrectly. Ending inventory is 1320. We want this ending inventory to be equal to what we just calculated. If ending inventory is now 1320, then we can force the amount of goods sold to be 5,000. Why does that work? Because we have to take the goods available less the ending inventory to equal the cost of goods sold. Or you can go the other way. You can take the goods available less what you sold, and that will equal ending inventory. Right, now that we know these numbers, we would go ahead and make the journal entry. Like in this case, the cost of goods sold is now 5,000, and it changed automatically because I used cell referencing. And that's different than how we did it with Fifo. But let's go ahead, even though we don't need to, let's go ahead and show how we would calculate cost of goods sold using Lifo directly. Again, Lifo assumes the last one in was the first one out. So we had sales of 750 units during the month. So we're going to work backwards. The last layer we purchased was 500. We purchased 500 units on June 23rd. We're going to assume those go out the door first. Right? Now we still have to count for 250 more. Well, of that 650, of the 500, I've got another 150 to go. So I've got to take 150 out of that 370. Again, I want to show this as our total sales that we had was 750 units. So of the sale of 750, we had 500 go out the door, and then 250 from the next purchase. There's 500, 250 of the 370. That accounts for our total amount. The 500 were purchased at 70. The 250 units came from that layer, the layer on June 20th, and those cost us $6. And now if we do our multiplication and summing the two units, you see I do equal that same 5,000, so we've done that one correctly. Alright, so what have we seen? Well, we've seen that in periods where prices rise, cost of goods sold is higher when you use Lifo, which would make sense. The last one in is the first one out, so the higher costs make their way to cost of goods sold on the income statement. Now, if cost of goods sold is higher using Lifo than FIFO, that means when periods where inventory is rising, Lifo will always get you a lower net income number, because cost of goods sold is treated as an expense. It's an expense, so it's a reduction of revenues from the period. Therefore, if expenses are higher, net income for that period is lower. Okay, so hopefully that's a pretty good example of showing how we would calculate inventory using Lifo. Now, the last one we want to use is average cost. So again, let me create some new rows, and we'll take a look at average cost. And when we say average cost, it really is weighted average, as we consider how many we purchased at each price to compute the average. All right, so now here's what we do. We come up and we know we had 6,320 units as our total cost. Goods available were 990. We don't even need to calculate this information here. Instead, we just calculate the average cost by taking the total cost and dividing it by the goods available. And we say the average cost of our inventory and our purchases for the period was $6.38, and I'm going to round that, or at least show it just as $6.38. So if we want to know what was the value of ending inventory, we know ending inventory was 240 units. We value it at $6.38. That's all we have to do. Cost of goods sold is the 750 units, right? Now we showed that as a minus, so let me show it as a positive by subtracting it here. And we use the same average cost. Okay? And now all I've got to do, well, actually I'm done. That's all there is to this using average cost. Now the entry, instead of being made for $5,000, we know that we're always going to use 638 to come up with those values, right? It's the 638 that comes up with the dollar amount of both goods available, cost of goods sold, and inventory. In other words, we use 638 for both purposes. And now I don't need to highlight the yellow anymore. We made a point of that before. So cost of goods sold, oh, by the way, because that's negative, I want to flip the sign so that it comes back as a positive. And what we get with using the weighted average method is a debit to cost of goods sold for $4,788 and a credit to inventory in the same amount. Okay, so this is a quick example of how you would use FIFO, Lifo, and average cost to come up with the entries you have to make to determine what's the value of ending inventory and what's the value of cost of goods sold. And I hope you found this helpful. Thank you.